Market Boys, where we follow the money and break down what the markets are doing, and most importantly, try to figure out why they're doing it. I'm Xzabko Scott, and today we're going to talk about 3 things that can make investors lose sleep faster than checking their portfolio on Monday morning. One of the things are inflation, politics, and the stock market decline. Now, here's a question I want you to think about throughout this episode. Are markets actually telling us something is wrong, or are investors simply getting nervous about what might happen next? Because there's a big difference. And if you've been watching the markets lately, you know something interesting is happening. We've had periods where stocks push towards record highs, and then suddenly investors start asking, wait a minute, should we really be this optimistic? That's the market. It's basically only placed where people can celebrate making money while simultaneously panicking because they might lose money. So let's get into it. Let's start with inflation. Here's my question for you. Do you actually know what inflation is costing you? Not the number you hear on television. I'm talking about your actual life number. Groceries, insurance, housing, utilities, gasoline, and the restaurant bill. Because we have to go out and celebrate. It's just one thing that we like to do, right? Because here's the strange thing about inflation. Even when inflation slows down, prices don't necessarily go back down. That's something people misunderstand. If inflation goes from 6 to 3%, that doesn't mean everything becomes 3% cheaper. It means prices are generally increasing at a slower rate. And that's a huge distinction. Imagine I tell you, good news, your rent isn't going up $300 this year. It's only going up $100. You might say, that's great. However, no, it's less bad. That's inflation. The Federal Reserve has spent years trying to figure out inflation back towards its longer run goal without crushing economic growth. And tomorrow, markets are waiting for the July CPI report. That report matters because investors aren't just looking at today's prices. They're asking, what does this mean for interest rates? And then the next question becomes, what does that mean for stocks? That's where inflation connects directly to your portfolio. Here's something I want you to think about. If your income increases 3%, but your cost of living increases 4%, did you really get a raise? Technically, yes. Financially, maybe not. Your purchasing power may still be declining. And this is why inflation isn't simply an economic statistic. It's a wealth issue. Because if you hold cash for too long while prices rise, your purchasing power can quietly erode. You don't receive a statement saying, congratulations, inflation just took 500 of your purchasing power. It happens silently. And that's why investors have to think beyond. How much money do I have? The better question is, what can that money buy me 5, 10, or 20 years from now? That's a quiet and completely different question. Now let's talk politics. Today, August 11, several states are holding congressional primaries, with more primaries coming later this month. The Federal Election Commission calendar shows Alaska, Florida, and Wyoming scheduled for August 18, for example. And here's my question. How much should investors care about the election? My answer, they should care. But they shouldn't panic, however. Markets doesn't necessarily care whether your favorite politician wins. Markets care about policy, taxes, government spending, regulations, trade, energy policy, interest rates, healthcare, corporate rules, and ultimately, what does government policy do for corporate earnings and economic growth? That's the part investors care about. Think about it. If a company suddenly discovers that a new regulation is going to cost hundreds of millions of dollars, investors are going to care. If a tax policy changed the company's after-tax earnings, investors care. If tariffs increase the cost of import materials, investors will care. If government spending stimulates an industry, investors care. Politics becomes economic policy. Economic policy becomes corporate earnings. And corporate earnings eventually shows up in stock prices. But here's what investors get themselves in trouble. They confuse political emotion with investment analysis. You can strongly dislike a politician and still own companies that perform well under the administration. And you can strongly support a politician while owning investments that perform terribly. The stock market doesn't care about your political feelings. It cares about cash flow. The market is brutally nonpartisan. It doesn't wake up and say, I really like this candidate today. Let's increase the S&P 500 by 2%. It asks, what will this policy do to earnings? That's the question investors should ask always. Now let's get to the part where everybody wants to talk about, the market decline. Here's the first question. How much of the decline are we actually talking about? Because investors have funny relationship with red numbers. The market dropped 2% and somebody on social media announces, the crash has begun. Then the market rebounds 3%. Suddenly. That's the market. The bull market confirms that's not analysis. That's emotional whiplash. Recent trading has shown how quickly market leadership can rotate, particularly between technology-heavy stocks and more traditional sectors. Some recent sessions have seen the major indexes have very different beneath the surface. And that's important because the headline might say stocks fell today. And the real question is, which stocks fell and why? Was it technology, small caps, financials, energy, consumer discretionary, or was it simply profit taking? That's where we have to go deeper. So let's make this practical. If you're watching your portfolio right now and you want to ask yourself 3 questions, am I investing or am I reacting? If your entire investment strategy changes every time CNBC, Bloomberg, YouTube, social media gives you a new headline, you don't have an investment strategy. You have a reaction strategy. And those are very different things. What happens if inflation stays higher for longer? Don't assume inflation automatically disappears. Think about what higher inflation could mean. Interest rates, bonds, consumers, spending, corporate margins, real estate, retirement income, purchasing power. The goal isn't to predict perfectly. The goal is to understand the possibilities. So, what is my time horizon? This may be the most important question that you ask yourself. If you're 25 and investing for retirement at 35 years from now, a short-term market decline is one thing. If you're 65 and taking withdrawals from retirement portfolio, that's another thing entirely. Same market, different investor, different risk, different strategy. That's why saying the market is going down, so everybody should sell, it's terrible advice. And saying the market always come back is somebody should buy can also be terrible advice. Context matters. So let's bring all three subjects together. Inflation, politics, okay, and the stock market. They're not separate stories. They're connected. Inflation influences interest rates. Interest rates influence borrowing and valuation. Politics influence fiscal policy, regulation, taxes, and trade. Those policies influence businesses. Businesses generate earnings, and earnings influence stock prices. That's the chain. So when you see a red day in the market, don't immediately ask yourself, should I be scared? Ask, what changed? Then ask, is it temporary or structural? And finally, does this change my long-term financial plan? There are so much better or so many other questions, because successful investing isn't about predicting every headline. It's about understanding what you're looking at. And remember, the market doesn't reward the person who panics first. It rewards people who understand risk and maintain discipline and know what they own. I'm Xzabko Scott, and this is the Market Boys. We follow the money, we question the headlines, and we try to understand what's happening before we decide what it means. I'll see you next episode. And until then, watch the market, but don't let the market watch you.